All right. So we will be live soon. Now I know what happened. All right. We are live. Hello, people on YouTube. Very, very testy day. I have Raghu with me here. Say hi, Raghu.
Hello, hello.
Okay, so today is going to be pretty structured. It's been a rough day, very, very active day for a lot of people. The um, the members, the live room was hopping 340 people at one point, but it was I was pretty proud of the level-headedness of a lot of people, even though there was some shenanigans overnight from Wall Street. So I wanted to start first. I have Raghu Ram with me here. If you don't know him, you're going to get to know him pretty well. I'm Nick, and the point of today is to get a checkpoint. New quarter coming, a bad day, the worst in a long time. A lot of people would say today they've never seen a 5% day close. We've seen 5% drops, but it's been like either after hours or dip in the day, and then we bounce and we close high. So the idea is to first give perspective because perception is the world is ending. Well, let's put some perspective. And I'm looking at the SPX, the S&P index, on a weekly chart. And on the weekly chart, it looks a little bit less worse than before. And so let's start with some perspective that calms us down a little bit. It is an emotional day. Some people made a lot of money, some people lost a lot of money, and some people's portfolios are drawdown, not yet lost, but it looks pretty bad. So let's settle down so we can level out the emotions. So the first thing is perspective. This is a weekly chart. We've had bad drops before. We will find a floor, and Raghu will help us with his opinion of where might support lie. Okay. So that's a weekly chart. I will drill down to a daily chart for a little bit better perspective. And now you start to see, okay, starting to get a little bit more emotional. Okay. But after today, after just 45 minutes plus your questions at the end, hopefully we will have a better handle on things. So I will start by handing it over to Raghu to see what his perspective is. So I'm he hopefully he will have I'm sure he has a lot of homework. He does a ton of homework. I benefit from it. Lucky to have him on our team. Hopefully he can give you some quality research to ponder so you don't just go on emotions and whatever the heck CNBC says because they don't have your backs. So
Perfect. Thank you, Nick. Folks, just to give you a very quick reminder, this is the information that is contained here. I have got a bunch of research in the last 3 days. End of the quarter, I typically get a lot, and I've been walking through all of that, and then I've just tried to summarize as much as I can so that you can get the gist of it. But the whole idea is that whatever research has happened, I think in one day everything became outdated just because of the way the markets have been. But let it not uh, deter us from getting the big picture and then see how we can prepare ourselves going forward. Okay, so keep in mind that just because something has happened in the past doesn't mean the same thing is going to continue. Okay, so it can be up, down, going nowhere, whatever be the case. Okay, so let's go with, now that we all seem to be liberated as of yesterday evening. Okay, let's see what is coming next. Okay, so this is just a summary. So this tells you since election and quarter to date where the entire world is with regard to the markets. You'll see a lot of red. The only greens are in natural gas and commodities. Gold has been ripping itself up. Okay, so if you would notice, anyone who has had any money in stock, doesn't matter, there is no place to hide. Okay, you are probably in a drawdown, me included. Okay, the question is whether the drawdown is really hurting you really bad, or whether the drawdown is something where it is like, yeah, it is a bruise, so you put a band-aid, wait for it to heal, and move on with life. Okay, and that determination and that difference is based on how prepared you have been 6 months back when the markets were really at the top. Okay, so when we talk in terms of how to manage risk, you don't talk about risk only during the time when you really need risk. It is like trying to get an insurance when you are in an accident or about to get into an accident. Okay, so you want to really talk about risk management right through the entire game, and that is very important. The reason is that we have been talking about this. Had you been managing the risk while the market was going up, okay, you would be in a much better position to take care of this drawdown. Where even though the drawdown is around almost 30 to 40%, and in some cases 50% in some stocks, okay, you could still be better prepared. And this is a time where maybe, okay, maybe there is still a lot more to go, but you may want to start looking at, okay, have a list of stocks to buy, and this is a good time to look at it. So this gives you a perspective. We are below major supports. Let's see if the 61% Fibonacci holds. Today was a very it was testing that. Let's see if it holds. Same thing with Nasdaq. It's important, but my gut feel says that we may have some ways to go, maybe at the 76%, but we'll see. Okay, so I'm not really going to say, hey, this is what is going to happen next, but at least from a standpoint of where the markets are and with this administration, the way things are going, it's a lot unpredictable on the very short term. Having said that, let's look at where we were when we looked at, I don't know if some of you had attended I did a webinar probably, I think, in late December, just before Christmas. And we talked about this 2025 forecast, where we said that there is a base case where there is a high probability that, the bull markets will tack on an average 8 to 12% with pullbacks in Q1 and Q3. We did get a pullback in Q1, but what is happening is the odds are increasing for the worst case scenario to be something that will actually come into play. Okay, now let's look at why exactly it is, and for that I'm going to switch over to a simple research. So I got a bunch of research over the weekend. Okay, so I'm going to switch to another deck. I'm not going to show everything, it is a very long research, but it's in the same format as what I had done earlier, except that it's in the same process. So one of the things that we have seen in the last month or two is that the breadth is slowly increasing from just the max 7 to a much more broader set of stocks. Okay, it's not necessarily all the small caps and mid caps, but it has gone beyond just the max 7. So money flow as such has broadened out. Okay, it is depicted by the number of stocks that are at a 52-week high. It has slowly crept up. It's not at the levels that we were in 6 years, 6 months ago, but it is slowly better than that. So the second thing is the cumulative advanced decline line. Even there, it is trending up. Okay, so that is something which is good, because especially when the money is again coming back into the stock market, you will see a much more broader participation, and you will not have that spikes based on just Apple or Microsoft or one of those stocks moving up and down. Okay. Next, there is a um, tool. This is not something, this is based on, again, partly AI, but What it is based on seasonality to a certain extent. um, what it actually shows is it basically takes the previous pattern, looking at 1 year. It is not 10 years, it is 1 year, and it chalks out a predicted path. Now, whether this will look the same, this is based on data as of 31st March. Whether this will look the same today, I don't know. But it's still trending up going forward for the next year. So this is a positive thing. Okay. Um, Third, AI boom. We talked about this. And the one thing that I see that is really standing out is with regard to Chat GPT. Currently in the AI, we are in the Chat GPT mode. It is exactly tracking the way it was with the browsers, Netscape. Okay. So if this is what it is, so look at it this, the blue was the Netscape. We were in the bottoming process at this time. We are in the same process right now. Hopefully we are going to hear something positive that may bring us back to the highs. So this is the closest correlation we can see in the technology space, where if you match it to a particular pattern based on past history, that's how we are tracking. Okay. So having said that, I'm going to switch a couple of 1 minute. Let me see. Forget about the Fed. Inflation, I think, is we will know about it in the next. I think tomorrow there is tomorrow there is a payroll report. Inflation we will know later. Tomorrow there is also going to be Fed speak, so be prepared for that. Labor market is the one positive thing in that has been holding up, which if it does continue to hold up, we will know a little bit tomorrow. Okay. But if it does continue to hold up, it is, I'm not really bothered too much about the Doge impact of it. It is more on the private sector because US is more of a private sector employer, okay, especially small business and medium business. If it does hold up, then consumers can hold up. Now, what needs to be seen is whether there is going to be a switch in behavior pattern with regard to consumers starting to save, because a lot of things are pointing to a recession. Okay. And if that does happen, what will happen is the first thing that the consumers are going to do is consumer staples are probably going to be, people have to eat or drink. So that is going to be the one where money flow will increase. But discretionary and things like cars, automobiles, and luxury items and all that are the ones that will take a hit. So we will see. But healthy labor market is really good, especially in the US. Okay. um, the earnings season are starting off. It's going to be very important what uh, we are going to see now. I frankly personally think that many companies are going to hold off on giving any guidance, okay, primarily because of the uncertainty around the tariffs. So we will see how this is going to pan out. But this can be an early indicator, especially if there is going to be any pullback on infrastructure spending and things like that. Okay. So having said that, let me see. This has been pretty bearish. I'm going to skip through this one. Seasonality. So seasonality wise, I'm a believer in seasonality. I follow that quite a bit. We are in the month and a quarter where April and May is going to be, seasonality wise, the start of a I wouldn't call it as a bull market, but more of a reversal that will happen. When it will start happening, we don't know. Okay. I think currently the market is very focused on headlines, but as soon as things stabilize, I think we are going to see institutional money flowing in, primarily because major see one of the biggest thing that you need to note is that um, majority of the 401ks and all these pension funds, their highest funds inflow happens in the first quarter. Okay, primarily because new people joining in, starting off with putting it into 401ks and things like that. So the funds will be having, they will be flush with cash. They will be starting to looking at putting this, so that is one of the reason why typically Q2 is where you would generally see seasonally an uptick in the stock market. Okay, so we'll see whether this holds this year as well, or whether it is going to be the other way around. Okay, now let's talk about the rapid drops that we have seen, right? So we saw a 10% rapid drop in the last, from the February 19 high. And if you notice, uh, this is something where we are looking at whether there is any kind of a correlation to the past instances where these kind of rapid drops have happened. And if you notice, see, today we actually went below this. So we have come all the way below. So it is more looking like this part. Okay. Or even like this. Who knows? Hopefully it is not like this or this. But in all these cases, right, if you notice, S&P made an all-time high by the end of the year. Okay. In all these cases. Okay. Only exception was in March 2001. So hopefully, let's see. I'm not going to say whether we are having a bottom right now or not, because we broke through some of the strong support zones that were there. So we will have to see where the real support is. But once the support is established, it looks more like this. We should see whether we are going to be back into going back up above. Okay. Let me see if there is any other pertinent research that is there. One second. Let me. All right. So let's. We looked at all the pros, right? So I'm going to look at what are the things that are probably not going to work out. So first thing is correction. We are in a correction, and it hit correction territory, which is 10%. Whether we are going to hit a bear market territory, we don't know. That is 20%. But the average drop during corrections have been about 18%. We are nowhere near that. Okay. The good thing is that this happened during end of March. Had this happened in mid February, we would have probably had a proper correction. We will see whether in April, whether with the new funds that are coming in, this will hold good. But this is one of the things that we need to watch out for. Um, the other thing is, the current bull market is now in year three. Typically, third year is a consolidation year in a bull market. And most of the time, you will notice in this chart, you will notice that the first 2 years when it has been very strong, the entire bull market is strong, but typically the next 5 months and a year, the next 5 months and the next year, you will see a few years where they were reds. Okay, we are already, showing the red right now, so we will see where you know we are going to go with this. But typically, this is a consolidation year in the bull market, and if that is going to be the case this year, we shouldn't expect a lot of upside. It may be that even if we get back to a new high, that will actually keep the bull market alive instead of going into a bear market territory. Okay. Technicals is where things are really bad right now in the near term and short term. I will show you one more chart. This is something which I get, on a regular. This is a live chart. This is as of today. Okay, so see this. Yesterday, as of now, yesterday was 5,408 was the pivot low. It got shifted down. Okay. So if we break now 54.15, we can see a significant downside. Okay. This it's a very detailed algorithm. I don't want to go through all that, but it is typically used by hedge funds for algo trading. But right now we need to see if we can at least get back above 55.71.50. If that, within the next 5 days, it gives about 5 days. Okay. Within the next 5 days, if we don't get above, even if we stay within the zone, it is okay. That means we are basing it. But if we break through the pivot low, the low can be much further down. Okay. So just be on the watch for that. So we broke the 200 DMA, which is a very significant part of both S&P and Nasdaq, and we are breaking through the support zones. So we will have to see how far we go. But right now, I wouldn't advise significantly moving in. Now, let me say that I've been nibbling a little bit on a few tickers that have been on my watch list, especially because when the going was really good, I moved quite a significant amount from in my fund to the cash. And this is a time where I would like to pick up at probably the low. It may not be the lowest pick I may have. Like for instance, when I see Microsoft below 385 or 380, it's attractive because the company is a solid company. I know the product pipeline that they have. Same thing with companies like ANET, or for example, I know Nick doesn't like Tesla, but Tesla is going to benefit from this tariff drama that is going on. Okay, after all said and done, the real thing is not about Tesla cars. It is all about their robotics and things like that. That is the long term. So if you're looking at the long term, look long and don't go all in right now. But this might be a good time. When there is blood on the streets is when you really want to be picky and choosy and then start picking up things that interest you. You should build a watch list and then start looking at things. Um, I showed you about the yearly path based on where S&P can go, but look at it. Near term, 3 months, if I change the predicted path, it's more of a sideways kind of a move. So we may or may not see the kind of April that everyone is probably looking for. Okay, keep that in mind. I'm not going to go through these things because, yeah, valuations are pretty high. Even by Warren Buffett standards, it's pretty high. And with the kind of deficit we are running, and with potentially recession in the works, that may right now there is a 38% probability of a recession right now, based on all the various statistical models that are there. The moment it goes above 50% is where I would really get worried and then be really hedged. Okay. But we will have to see how things pan out. uh, this we all know about it. Okay. Semis is one thing you need to watch out for. Early indicator, this is a very early indicator. Semis have been struggling. Okay. This would be the first one to turn around if the economy is going to turn around. There was a headline today right around close. I don't know how many of you noticed that TSMC is going to invest a significant amount collaborating with Intel in a joint venture in the US. Okay. Now, it could be something positive because if Intel was collaborating with some unknown company I wouldn't have really cared about. TSMC is a market leader. Okay. And if they are going to put money into it because they know that they have to do something about it, if not they will lose out on some of the based on the tariffs and things like that. So that is going to be something to watch for, because they are going to invest in foundries and things like that, more jobs in semiconductors coming back to the US. But semi is the one you need to watch out for. This has to turn around for the overall market to start looking at it turnaround. Okay. Um, Consumer, yes, I'm not going to go too much into these. Uh, Credit is pretty weak. The good thing is at least the interest rates are dropping. And with the interest rates dropping, who knows? There is going to be political pressure on the Fed to actually cut interest rates. I think they are going to hold. So we don't know how it is going to pan out. But if the inflation is under control, and if what Jay Powell said, that, he used the word transitory again, what happened the last time he used the word transitory. So he says that right now the tariffs, the impact is going to be transitory on inflation. So we don't know. If that is going to be the case, there can be a cut. And if that cut does come earlier than usual, that can be the catalyst for the market. Okay. Um, we know about the tariffs. Okay. So having said that, I'm going to. This is one more. I don't know how many of you follow Almanac Trader. They have this where we are currently we are following a seasonal pattern, but it's more like in this pattern. Republicans, okay, we are in control, so hopefully this is not the case, but we'll see. Okay. Okay, so when we talk about recession, so this is a very good chart. Now I posted this in Discord for those of you who are in Discord. This comes out once a month. Okay. um, Look at the company that produces it, recessionalert.com. So what they do is they do a lot of data based analysis. Okay, so this is like a cockpit in a flight. Anything that is in red means that it is something where uh, there is probably something where it is associated with recessions. Orange is something to watch out for. Green is expansion. So it has multiple things. Like, for instance, based on the seasonality model, we are on the strongest part, right? April is the strongest in the seasonality. Um, there is a recession forecast that they do. There are two forecasting tools that they do. One of them is pointing to a probability of a recession in the next 6 months. Okay. The other one is almost on this, it is moving from here to here. Okay. Now, whether this will pan out or not, we don't know. Okay. The thing is, the green arrow indicates that it has, things have expanded a bit, it has moved to the right side, but we will have to see. Yield curve, it's dropping, it's almost neutral right now. Composite market index, this is dropped, and I'm sure if this gauge is done today, it would have gone into the red. Okay. The 4 week balance sheet change is dropping. Okay, which Fed has already said that it is, trying to, restrict the balance sheet. So they are still trying to do that. So it is dropping. There are few things with regard to the macro models. What I would like to highlight is this is the one which is concerning. If we see a lot more labor, unemployment rate going up and labor participation dropping, this can lead to a recession. Housing is already giving us that indications. There is, the affordability is very low, and generally overall the rest of the world seems to be doing better than the US. Okay, so this is just a very quick snapshot, tells us where we are, and it gives me a very good view of how much belt tightening someone has to do looking forward 3 to 6 months out. Okay. So, in summary, okay, the headwinds that we have is the shakeup. Okay, the shakeup is happening. We still have uncertainty. As much as we think that tariffs have been announced, I don't think the details are announced yet. And today I saw a couple of Trump's cabinet members, including the Treasury Secretary and all of them, talking and then saying that there will be no negotiations, and then Trump tweeting right in the afternoon saying that, oh yeah, he's open for negotiations. Now you don't know whom to believe, right? So there's all kinds of things going on. There is geopolitics that is going on with Russia and China and Middle East. Economy is slowing, labor is softening, and inflation is still stubborn. So these are the headwinds that can be negative for the markets. What are the tailwinds? Tailwinds are the ones where we can potentially overcome some of these things. Like, for example, who knows if there is going to be a tax cut based on, if they say that truly 1 trillion in deficit, if they are going to cut and they are going to put it into tax cuts, that is going to spur consumerism, right? Um, Cost savings, and then whether inflation is going to be steady and dropping, we will have to see. The real outlook is that markets are going to be choppy. Okay, you got to be prepared for that. We can see new highs later, um, but it all depends on whether there is going to be some level of stability and investments coming back into the US, for example. Okay, um, potentially more rate cuts. Who knows? But right now, the markets are saying that there is not going to be any rate cut. I think based on, if inflation shows up, then I don't think there is going to be any rate cut for the rest of the year. But who knows? J. Powell knows how to surprise the markets. 10% correction, we already got it. Whether we are going to go into a bear market, we don't know. Okay. So after Q1, typically when Q1 is down, it sometimes also says that the rest of the year may be sideways to down. Hopefully that may pan out to be different. Okay. So with that, one of the things what I wanted to talk about is how do you prepare yourself, right? In all these cases, see, you cannot predict what is going to happen. You don't want to start looking at managing your risk when the markets are at the all-time lows. You want to do it on an ongoing basis.
So, Raghu,
Yeah. So Nick, take over from here.
yeah, no, not take over. I'm gonna layer on top of it. So
Mhm.
today, you mentioned we had a 10% correction. Actually, we did a little bit more than that
Yeah.
after today's drop. But on the theme of getting prepared in time, so you know how I usually say, if you want to fix a bad trade, set it up better. So the defense starts on the setup. And part of the setup process, correct me if I'm wrong, is to always be well balanced. So you hear people say, spread your risk. So spreading your risk involves going short and long, spreading your risk in the type, which industry, which time frames. Spread it in any which way you can. So what Raghu does a lot well, you see his trades are a little complicated because they're all spreading risk. He's shorting what he's going long, and he's going long what he's shorting. So it's give and take. So last night, if you guys were with us in the live room, we at the close, the market was super strong, to illustrate how important to be hedged and the tools to hedge. So I'm going to use that as a segue into what I think we should talk about next. So the market was signaling, okay, we might have a small dip based on technicals, and and then the event started and the market spiked, and I believe it was Maria in the live room said, "What do I do with the ES, the futures?" I said, "You short the S out of it," and then it dropped. So if somebody did actually short the futures contract, they could have made a fortune. Literally, it's the kind of trade, even one contract would make your year for certain accounts, which is the next topic of conversation. In order to just globally continually hedge the market, would you say that using the futures, whether you want to trade them actively or not, um, would be an appropriate way to balance a portfolio? I think you do it already, so I kind of know the answer, but go ahead and take it from here.
Yeah. So one of the things is, futures. The reason why I think futures is really good is one because, like, think about it. Yesterday night, right? The markets closed at a good. It was a good recovery from the last week. But then Trump started speaking, and the market actually spiked when he started speaking, because initially the indications were that, hey, the tariffs are not going to be as bad as it was what the market expected. Now, there, I don't know how many of you got assigned SPY shares and things like that. I got assigned some SPY shares,
I
by the way.
I, I know six people.
Yeah, but here is what I did, right? I had SPY shares that I know will get assigned. Okay, I immediately shorted to compensate for that. Okay, and you wouldn't be able to do that. Well, what you can do is you could sell for about 20 minutes, 30 minutes. Okay, SPY shares in the open market, but you cannot trade on the options. Okay, but if you know about how to manage futures, one, with just one future contract, you can actually short a big chunk of the market. Okay, significant leverage. That is one part, with less amount of buying power that is required. Second, more importantly, futures also have options which gives you much more higher leverage with lesser risk. One of the things that you want to do is, and this is something which I keep telling, and this is what we talk about it in our futures classes. You want to use futures to hedge, but whenever you hedge, okay, you are going to pay a price. The price is in the form of, think about it, when you are going to go with a car insurance, you're going to pay the premium, right? That is the price. And the price is relative to how costly the VIX is. That is why we keep saying that, hey, when the VIX is high, it is good to sell but not to buy. So when you're buying insurance, when the VIX is high, you're paying more. But with futures, one of the things you can do is you can get paid. In fact, you want to actually be paid and be protected and hedge yourself, and at the same time get income, okay, without much of a risk. And those are some of the strategies that we actually talk about in the options, in the future session. And it is not something that we can talk in detail. It is, you need to understand even when to actually move in with that, how to actually create a ladder. We talk about the ladder strategies. We talk about different ways in which you can actually protect yourself. Okay, but without futures, it will be really tough for you to manage a situation like yesterday, for example. Okay.
Okay. So this is the time where I come in with a small commercial. We have an event in April. Most of you already know, April 17th and 18th. It's in Orlando. 17th and 18th, that's a Thursday and a Friday. We did it during open session on purpose. Raghu is going to be delivering an excellent seminar. He's done it before. Is this your third or fourth? Third.
Fourth.
Um, okay, and the content keeps getting better and better.
Fourth.
So
Fifth, I think.
if you know your way around basic options, so where you understand spreads, if you understand charts to the tune of, if you're watching my screen and you understand what's going on my screen most of the times, I think you can do well with the futures content. Now, I've said this before and I'll say it again. Any serious investor that is in it for the long term, or that has a lot of money in the market, you want the ability to trade the futures, whether you want to be an active trader or not, because you can ladder a strategy that works for you, creates cash while providing you plus or minus 8% buffer. And it could also bail you out. Like yesterday, I know for a fact somebody in this room, I saw your name out there, um, that got assigned SPY calls on the spike. Nasty market makers, nasty brokers. They assigned them shares at 559, and they were powerless to do anything else. They could have theoretically sold a contract in the future to make up more than the loss that they ended up with, and it was a severe loss. So market makers can play tricks on you, but if you can control more of your destiny if you know most of the tools that they have, which is trading the futures as well. Just a word. So it's a small class, so the content is better absorbed. I will be there as well the whole time. We will have a good time. We'll hang out through a couple of meals at least, and you will make friends forever. And you will get to be in the Discord until the end of the month if you're not a member already. Courtesy invite there as well. I think you are going to love it. I'm confident in the content that Raghu brings. He proves it in every day. He is an active trader, which he hasn't said. And by the way, Raghu, thanks for being here. I know your face is all busted up, and there are
Yeah, no problem. And you get this tool.
yeah, subcutaneous stitches. You get his tool, and you get my tool, and more than my
Look at
tool.
this. Look at this. You don't need to do anything. It tells you when the markets are going to reverse. Right now, it's in yellow. It tells
I have
you
my
when to
tool
buy
as
and
well. I
sell.
have a similar tool like this for TradingView. If you don't have Thinkorswim, you will have it on TradingView. Very, very similar to this one. I'll see if I can copy that one for TradingView as well. But it's well worth it in tools alone. But the content is invaluable. So the only commodity that you really have to think about is your time. How much of your time are you willing to give in order to grow your knowledge? And that's only 2 days out of your life. Plus, it's an excuse to get away from walking the dog and taking care of your family for 2 days. All right. So, content wise, I know we've answered some questions. What percentage of the portfolio to use in the futures? That's a pretty broad question that deserves a little bit more time than we have here.
We
Um,
do cover that in the futures.
yeah. Okay. So I know the content is there. So if you have time to come join us in Orlando, that's probably your best bet. Um, what time is it? We have some time for more questions if you
Yeah,
guys
if there's
want.
any questions, yeah, we can take some questions.
So I had some questions today about how to handle fast trading, and some questions about I'm ready to sell some puts. So what I think Raghu touched on is don't panic, do anything. There's no rush to do anything. If we bounce tomorrow, that doesn't mean we're going to the moon. If we drop a little bit more tomorrow, that doesn't mean we're going to hell. I posted while Raghu was talking, the small caps have corrected 22%, almost 23 from the
Mhm.
highs, almost 13% on the S&P. I haven't checked the Nasdaq. It's probably even deeper than the S&P. So um, corrections, it's a process. So instead of looking how deep can we go, just focus on the process. We're going to be selling rallies like we have been since the middle of February. Most people don't realize that. The middle February 20th is when we started not making higher highs anymore, and we started to drop lower lows and lower highs. And we went sideways for a little bit after 313 when we had this big bounce on 314 Friday. And then we fell below that. So we continue to sell rallies. So focus on the process. What's next is we're going to try to sell another rally. So focus on the levels, on the process. Don't overextend yourself. Don't panic into anything. Um, the futures is more taxing than options. Is it true? Taxing on the health? I don't think so, because you open the trade and you close the trade and you walk away. Or you open a trade setup that balances a portfolio or balances itself by opening mirror images. I personally, if I were trading the futures, I would trade it actively. So since I am not a heavy portfolio builder at this point, I'm more of a trader. I tend to either trade it or so it's less stress for me because I'm on or off, as opposed
I
to if
want to address one more part because he said taxing on options, but actually, I would say it is actually tax beneficial to you. Okay, for when you trade futures because it takes care of the Section 1256 rule.
yeah. So the question is it liquid? Absolutely.
It is the most liquid of all the instruments that you have. Okay,
No. Okay, so
it is
tomorrow
all the
morning,
most liquid.
tomorrow morning we're gonna have the future, the whatever jobs numbers, and we have our Uncle Jerry talking tomorrow
Oh,
afternoon. Tomorrow, he's not speaking on behalf of the Fed tomorrow. I don't think so.
oh,
So
he's just going to be transitory. That's all.
yeah. So before the market opens, it's going to be bumpy already from the 8:30 on the East Coast time jobs number. But I would like you to refocus. You know, you hear me say it all the time. Not don't focus on the news. It's not really news. It's noise. Most of it is noise. The tariffs were here. The jobs numbers are inaccurate. So don't focus on them. Focus on what happens off of them. So yesterday we tried to focus on okay, let's see what the reaction is like and what we can do with it. So tomorrow morning it would be the same. Let's see what the market does, because it doesn't seem to be very smart, what it wants to do, and let's see how we can handle it. So everybody's waiting for this. When they started looking for this recession that's coming 3 years ago, something like that. The recession is coming. Recession is coming. Here we are, 3 years later, and it's still coming.
Mhm.
It will come, and it will go, and the markets will be higher in the future than they are now. We will have dips, and we will have rallies. All we need to do is just keep our heads straight and not overextend ourselves and be drawn down to hell. So don't do anything crazy. This is a trader's market, which reminds us of the concept that we've been pushing. I know it's boring. Investing will come. Don't panic, invest. Trading available all day. We did a good job trading today. So if you're going to join us tomorrow again, we will do the same thing as we did today. Hopefully, we'll have another 330 people. Raghu is in the room always. Fridays are his busy days, but I'm pretty sure he will answer questions if you have follow up questions to today. Last thing you want to leave us with, Raghu? Again, I posted in the comments a link to the sign up for April. If you have follow up questions, let us know. You know where to reach us. I will be in the live tomorrow. I'll log in early, like I did today, probably 4:15 a.m. my time, so that's 7:15 Eastern.
So,
All right, Jay. I don't know who Jay is, but Jay, I'll see you tomorrow. I'll answer your questions a little bit more, less flighty tomorrow.
so this is the latest hot of the press. Right now, it says that we are in DEFCON 2 for if it drops below this line, it's the recession
What
trigger.
what am I looking at? What is this?
So this is a very complex statistical model that talks about when a recession could come, but we are approaching that. The moment it drops below this red line, we can see a potential recession. Now,
Okay, those of you
this,
who don't know what DEFCON 2 is, that's war talk in the US. DEFCON 1, we have nuclear launching
yeah,
missiles. Okay, DEFCON
okay,
1 is you don't want that.
yeah, I know. So this is much more complex, but this is just a very high level summary. But we are not there yet. That's what I said. There is a 33, there is a 45% as of now,
So
based
here's
on.
the good news about that. Here's the good news. So let's channel the spirit of Mr. Buffett. He says, "Be fearful when nobody is, and be opportunistic when everybody is." I'm paraphrasing, but that's the kind of thing. So when everybody says, "Here comes the recession," I think this is where I get excited and I start
But
picking up the pieces of what
pick
people
it
are
up.
throwing away, because now they're panicking and backtracking and going backwards. So
Absolutely.
hopefully we're ahead of the game.
Yeah.
Stay calm and kill zombies.
All right. Thank you, folks. Hey, by the way, I have my mentoring starting next week.
Oh yes, I forgot. Yes, go ahead. We
So
we have spots for him. That's almost
we
like
have
one on
probably
one.
2 or 3 spots, I think. Yeah.
It's not quite one on one, but it's great attention. So reach out tomorrow in the live. We can hook you up. Not everybody qualifies. You have to fit the group that we have. We have a schedule. It's starting regardless, but we can slip one or two more people in there too. All right, we're going to end it early. We're all tired. I do appreciate you all. I think we had 100 people in here today. Thank you, Raghu. Again, I hope your face heals pretty quickly.
Hopefully,
And,
hopefully, yes.
and tomorrow we'll be up at it. I'm sitting in this chair for 12 hours now. Walked the dog once, had a bite. Raghu worked just as hard. He's a busy, busy trader. I'm sure you guys are all tired. And I'll see you all tomorrow in the live. We're going to rudely end it up in 5, 4,